So what we're going to move on to now is a working that we're always going to do when we have an SFP, often when we have an income statement question as well, an equity table, and it's S's equity table. Remember I said that equity is whatever's in there, so that's what you do. Whatever is in the equity, you just write down here. So we had share capital and retained earnings. Share capital and retained earnings, just write that in. Then we need to write in what it is at the year end, what it is at acquisition, so year end, acquisition when we bought it, and then finally one minus the other will be what we call post acquisition. Don't worry about it, let's do it then, year end. Now, this is always our year end. This is always like the question that you'll be given in the exam. You'll be given a year end balance sheet. It's S's year end that I'm interested in. It's S's equity that I'm interested in. So I'm interested in these two figures here. So share capital is 100 at the year end. Retained earnings is 1,100 at the year end. And I'm done. Now I need to go on to the at acquisition when we bought it. You always presume the share capital was the same. So when we bought it was 100, at the year end 100, you presume it was the same. But I want to know what the retained earnings were when I bought it. Okay, so H acquired 60% of S 2 years ago. 2 years ago is the at acquisition date. When S's reserves, here's their reserves, okay, which is only retained earnings in this question, were 260. So I know that at acquisition it was 260. So since acquisition has been 1,100 minus 260, which is 840. So far, so good. Now, what we've got to then do is just finish this off, because it then says the fair value, FV is fair value, of S's NA, of S's net assets, was 380. Now, have a look here. This is S's net assets at the year end, and they equal 1,200. And this is equity, S's equity at the year end, and it equals 1,200, because it always does, you know, the net assets equals equity. So, if we added the equity up at acquisition, the equity comes to 360. But I'm told the fair value of the net assets, which I now know is also the fair value of the equity, was 380. So I need to add on 20. We always bring S in at acquisition at its fair value. These figures here are just the book value. We've got them from the books. So I need to make a fair value adjustment of 20 to make it equal 380. So what's caused it? Well, it tells me here, look, the difference is due to PPE. So maybe the PPE is in the books lower than what its real fair value is. So its real fair value is 20 higher. Now, it's got a 10-year useful economic life. So, how much, 10 years, 10-year useful economic life, so 20, which is the extra here, divided by 10, I would depreciate that by 2 per annum. Because we depreciate PPE, don't we? So 2 per annum. Now, this was acquired 2 years ago. So since acquisition, there's been 2 years worth of depreciation. So 2 years worth of depreciation since acquisition is 4. So in the post-acquisition, there's been 4 depreciation. Depreciation's a cost, so I'll put it as a negative. So if at acquisition it was 20, if since acquisition it was minus 4, then at the year end it must be 16. And what I go and do is I put that plus 16 onto S's PPE, which is in their net assets at the moment, okay? Now, then I can add it all up, and that comes to 836, and that comes to whatever it comes to. Now, the point is, there's a lot there. I've introduced a lot to you, but what we're going to do about 30, 40 of these, and you're just going to get really good at it. So don't worry, we're just going to keep practicing, keep going back to this video if you like, if it doesn't make sense, but don't worry at the moment, we're going to keep at it.